According to indicators, the world economy is growing at good pace. The Fed and the ECB have again revised upward their economic scenario. And both Mario Draghi and Jerome Powell have become more confident that inflation will finally reach the 2% inflation target in the midterm. Even more important, according to the latest Fed inflation forecast, inflation will exceed the 2% inflation target in the next couple of years. It means that monetary policy is shifting from normalization towards tightening, and this means that interest rates will go higher. Despite a couple of leading indicators in Europe that peaked, the whole situation remained very positive. Optimism is there. Consumer confidence is high. Business sentiment is extremely high. And investors are also very positive. Analysts, for instance, expect that earnings in the US will reach a very high level. Despite these very good conditions, the equity market did not recover from the February loss. And we think that this is a sign of warning. We recommend to have a light exposure on equity market and a short duration on the bond market. We also recommend to have a light exposure on corporate bonds. In addition to high interest rates, negotiations on international trade are also very destabilizing. For the time being, it's difficult to know what is part of the negotiation strategy and what will be decided at the end. Regarding interest rates, in our latest issue of Investor Insight, we study in detail how high can interest rate go for each different activity sectors. Actually, we ask the question, how high can interest rate go for household, how high can they go for the state, how high can they go for the financial sector and for the non-financial sector. Obviously, we got very different results for each activity sector. Interested viewers can click on the link below to get access to the publication. Goodbye and see you soon.